Hello, everyone. Adam Bergman here, tax attorney, founder of IRA Financial. On today's video, we are going to be talking about last minute IRA tips for 2022. Yeah, I said 2022. Even though we're in 2023, there's still time left to make IRA contributions for 2022. So on today's video, I want to go through what those rules are, how they work, and how we can maximize those rules to make the most of our IRA contributions. So let's start with traditional, then I'll go to Roth, and then we'll talk about SEP and a little bit towards simple IRAs at the end. Although for a simple IRA, the employee contribution was actually due 30 days after the end of the year, so around January 30th. So employee deferral contributions for the simple are no longer available, but the employer, the match, technically is. So I'll just spend a little bit of time, excuse me, on simple contributions at the end, but really focus more on traditional and Roth contributions for today's video. So let's start with traditional contributions and Roth. I'll make a general statement and then expand on it. So IRA contributions are due April 18th, 2023 for the 2022 taxable year. Okay, so you still have time. It's less than a week away. And it's a reminder. This is a reminder to file your taxes, at least pay your taxes on April 18th. You can always file an extension. However, if you do not pay your taxes on time, there is a much higher interest rate this year that will potentially apply to unpaid taxes than previous years, right? Just that's inflation. And it's generally the Fed short-term rate plus about 3%, which is going to be around 6% or so. So that's a really high interest rate on any unpaid taxes that will accumulate as the time goes on for these unpaid taxes. So there's also potential penalties. So definitely by April 18th, which is next Tuesday, you want to file either a return or an extension and pay whatever taxes are due, because whatever is unpaid will compound and grow. So for 2022 IRA contributions, you still have time, as I mentioned, to all the way to April 18th, which is nice. No extension. So even if you file an extension for 2022, so let's say April 18th, you file an extension, okay? You can't do your IRA contributions beyond the April 18th, okay? Even though you're filing an extension, you can't do it. So for 2022, the most you can put away in an IRA is 6K or 7K if you are over 50. Those numbers have increased in 23 for 6,500 or 7,500 if you're over 50. Now, a couple things to keep in mind. Number one, you have to have earned income to make contributions. So obviously, Social Security, disability, passive income, like passive rental income on a Schedule E, capital gains, interest, dividends, royalties, rental income do not count as earned income. Essentially, what is earned income is when you perform services, you sell a widget, that is deemed earned income, okay? Whether it's on a Schedule C, whether it's a 1099, whether it's a W-2. Now, if you're married, you can always piggyback off a spouse. So let's say you don't work, but your spouse works, so long as they make more than $6,000 or $12,000. If you each want to make contributions or under 50, you can piggyback off a spouse and make those contributions. So one more rule to keep in mind. So now that we know what the maximum you can put away in an IRA, it's due April 18th, even if you file an extension. We know you need to have earned income. Let's discuss what those rules are for, will the IRA contribution be deductible, right? Because one of the main advantages of doing a pre-tax IRA is that it's tax deductible, meaning you can take that IRA contribution, max $6,000 or $7,000 for 2022, and deduct it. So let's say you made 50K, you can potentially deduct another $6,000 from that amount, or $7,000 if you're over 50. When you reduce your taxable income, you obviously pay less tax, which is one of the advantages of doing a pre-tax IRA. The other is obviously deferral. your money grows in the IRA without tax. So here's some rules in terms of, is the IRA tax deductible? So for 2022, if you're single, okay, and you're covered by a retirement plan at work, even if you don't contribute, if you make more than 78K, your pre-tax IRA contribution is not tax deductible. So you're basically just doing an after-tax IRA, which is kind of pointless because you don't get a tax deduction. And then when you hit 59 and a half, you have to pay tax on your earnings. And that's why when I get to the Roth, I'll explain why doing the Roth makes a lot more sense if you can't capitalize on a pre-tax IRA contribution. What about if you're married, filed jointly, and are covered by a retirement plan at work? Again, even if you don't participate in the plan, as long as the company offers the plan, if you make more than $129,000 in 2022, again, married, filed jointly, and you are covered by a retirement plan at work, you cannot get a tax deduction for your pre-tax IRA contribution. If you're married, filed jointly, and your spouse is covered by a retirement plan and not you, then if you make more than 214, you can't make a pre-tax IRA contribution. So what's going on here? Basically, the IRS is saying, we don't want to give you the opportunity to have too many tax deductions, right? They're trying to limit it. And they're saying, well, if you have access to a retirement plan at work, you can just contribute to that retirement plan. Why do you need to get the extra $6,000 in a pre-tax IRA? You should be happy with the $20,500 or the $27,000 if you're over 50. That extra $6K is too much. I don't know. It is what it is. It's kind of arbitrary. I agree. I understand they want to limit deductions, but you can just donate to charity. I mean, there's other ways to get deductions. The IRS is also worried about the deferral and making sure people's retirement accounts don't grow too high. Again, it's kind of hypocritical because they want us all to save. They're encouraging us to save. They don't want us to be a burden. They don't want us to rely on Social Security. But then at the same time, they're kind of limiting our ability to add just a little bit more juice to our IRA. So those are the income limits. You can still make the contribution. They're just not going to be tax deductible, which is not super exciting because you don't get the deduction. And once you're over 59 and a half, you have to pay tax on what you pull out. So it doesn't really have much benefit. You're pretty much better off saving personally because then you may be able to get a capital gains tax instead of an ordinary income tax. So now let's move to the Roth. Again, same rules as a pre-tax IRA. April 18th for 22 contributions, even if you file an extension. Okay, it's due April 18th, 6,000 if you're under 50, 7,000 if you're over 50. Now, unlike pre-tax IRAs, Roths have maximum contribution limits, meaning if you're single and you make more than 129K in 2022, you cannot do a Roth IRA. But let me put an asterisk next to this because I'm going to get to something called the backdoor Roth IRA in a minute, which will kind of show a workaround. If you're married, filed jointly, you make more than 204, okay, you cannot do a Roth in 2022. If you if you're married, filed jointly, it's actually 214, okay? It's not 204, it's 214. So once you make more than the 214, you can't do the Roth IRA. But again, asterisk. Why? Because there's something called the backdoor Roth IRA, which begun in 2010. Prior to 2010, if you earned above a certain limit, you were not able to do a Roth conversion. The IRS got rid of that. Why? In 2010, they needed to generate more tax revenue, and conversions are a great way to generate tax revenue. Why? Because you prepay tax. So what happened is they said, okay, let's scratch the conversion limitations. Anyone, no matter how rich you are, can do a Roth conversion. So that basically created what's called the backdoor Roth IRA, which means that even if you make $1 million a year above the 214 threshold for 2022, if you're married, filed jointly, all you need to do is make an after-tax IRA contribution and then convert it to Roth. And since you're going after-tax to Roth, there's not going to be any tax on that conversion amount, assuming you're doing it relatively quickly and that after-tax money isn't being invested in any income-producing activity. The only thing to keep in mind is this. If you have other pre-tax IRAs out there, then what that means is that there's a pro rata formula that will limit your ability to convert the entire after-tax IRA amount to Roth. What will happen, for example, let's say you had a pre-tax $5,000 amount, from several years ago, and now you want to do a backdoor Roth IRA of $5,000. You have 5 out of 10, which is 50%, meaning only 50% of the backdoor Roth IRA would be tax-free, and the rest would be taxable. So that's kind of a way for the IRS to capture some of the other pre-tax IRA amounts out there and make sure you can't just convert it all without tax. So again, the backdoor for 22 needs to be done by 23 April 18th for the IRA. Let's talk about SEP. SEP is a type of an IRA, essentially a profit sharing plan that's adopted by a business, whether you're a sole proprietor, single member LLC, partnership, Corp S. The SEP is either a 20% contribution if you're a sole proprietor or a single member LLC, up to a maximum of $61K for 2022. If there's no catch up if you're over 50. Now, if you're a C Corp, S Corp, W-2 guaranteed payment of a partnership, it's actually 25% of your comp up to a maximum of 61K. So if you made 100K and you are a W-2 taxpayer, you can contribute 25K. If you made 100K as sole proprietor, single member LLC, you can do 20% of 100K. That is due when your business files a return. So if you're a single member LLC or sole proprietor, it's your Schedule C on your 1040. So April 18th, plus extension. So the difference between a SEP and an IRA and a Roth IRA is you get to make the SEP contribution on April 18th, plus if you file an extension, you have the extra time to make that employer contribution. Where the traditional IRA, the Roth IRA, must be done by April 18th, 2023 for the 2022 taxable year. The SEP gives you the extra time to make the contribution up until the business files its return, including extension. So for a S Corp, it's March 15th or September 15th. For S Corp, March 15th or September 15th. C Corp, April 18th or October 15th. For a partnership, April 18th or October 15th. So that's the only difference between the SEP and the traditional and Roth IRA is you get to make the SEP contributions up until the company files its return, including extension. Now, for the SEP, as I mentioned, for the employee deferral, which is around 14K for 22, that had to be done by January 30th, so that's gone. But the employer 3%, or depends on how much you're doing, the 2 or 3%, the company has until it files its return plus extension to make that contribution. So I spoke last week about 401ks and solo Ks. So the big distinction between IRAs and like a solo K is you can technically set up a solo K, or if you have a solo K, you can make your contributions up until the business files its return, including extension. So the solo K essentially follows the SEP IRA rules, whereas the traditional and Roth IRA are individual retirement accounts. So they have their own rules, which basically are cut off for the 22 contribution cycle by April 18th, 2023. Whereas the SEP, the solo K, you have until the company files the return, including the extension. So that's kind of it. I wanted to keep things short and sweet. I know people are probably busy. It's tax return time. Everyone's stressed out. And people don't probably want me going on for 30 minutes plus on what are pretty simple IRA rules. So this is just a last minute reminder. There's still time to make IRA contributions for 22. You have until the April 18th, 23. And again, every year you add even a couple $1,000 makes a difference. Why? Because your money grows without tax. That's the power of deferral. If you do it in a pre-tax IRA, you do it in a Roth, compounding returns, your money will grow much faster in a tax-deferred or tax-free account than if you save in a taxable account. Why? It makes perfect sense, right? Your income and gains are not subject to tax on an annual basis, but are able to grow without tax. So I got a question here. If CARES Act distribution in 2020 paid 1/3 tax in 20 and 21, repaying distributions in 22, now converted to a Roth, need to file 2021. Right. So if you did a CARES distribution, you had 2 years, you paid the tax in 20, or you had 2 years to take it in. If you paid the tax in 2020, You can file a amended return, assuming you put the money back in 2022. You can file an amended return for 21 and 20 and hopefully get some money back. You can always do a conversion at any time. Now, if you prorated that over several years, you're not able to file an amended return. You can only file an amended return if you took in all the tax in 2020. If you decided to pay the tax over several years, that's it. The money's out of the IRA and you can no longer repay those funds into the IRA. So that's kind of it. Just wanted to thank everyone for spending some time with me today. I know it's not the most exciting of topics, but again, last minute reminders, every dollar you add into an IRA, think about this. You do this for the next 10, 15, 20 years. Even if you just do $1,000 over the next 15 or 20 years, that's an extra 15 or 20K of contributions that will essentially triple or quadruple, which will give you potentially an extra 70 to 100K, depending on your rate of return, for really just a small amount of money each year. So still have time. You can wire it by April 18th. You can write a check and just post date it April 18th. If you're a client of IRA Financial, let us know. We'll work with you. We want to help you. And obviously, every last dollar you can put into an IRA will ultimately help you and your family, and will create legacy wealth, hopefully, for generations to come. So thanks again for watching. Really appreciate it. And look out for next week's video. I promise it's going to be a fun one. Otherwise, enjoy a great YouTube channel. We drop 3 videos plus a YouTube live every Wednesday, 3 podcasts, which you can also watch on this channel. It's free. Yeah, it's free. You believe it? All this content free. So enjoy it. If you have comments, questions, let us know. Love hearing feedback. Have an amazing day. Don't get too stressed out on tax time, but try to pay your taxes if you can, because there's going to be a 6% plus interest rate that will apply to unpaid taxes. So that's it. Have a great rest of your day, rest of your week, and I'll see everyone again next week. Take care.